Thursday, March 11th, 2021, Moneco 64, home of alternative economics and contrarian views. So the bond market is settling down. It looks like yields are coming back down, despite the fact that the U.S. Treasury will have issued 120 billion of threes, tens, and 30s this week. You might think, how can they do that? Well, there's a few things that could be happening. One of them, I think, is like a nuclear option. It's debt monetization by the Federal Reserve. What does that mean? Well, that would mean that the Federal Reserve would be buying straight from the U.S. Treasury. That would be really something that they probably wouldn't want to do, but might have to do. And there's been a lot of talk in the last few weeks about the Supplementary Leverage Ratio, or SLR. Basically, what it means is that the bigger the Fed's balance sheet gets, the bigger the commercial banks and primary dealers' balance sheets, banks like JP Morgan, Goldman Sachs, HSBC, all the primary dealers for the New York Fed that are not only American banks but international banks, the bigger their balance sheets get, so the more leveraged they are. The ratio for statutory leverage has been removed until March 31st this year. And there's a lot of political pressure in the Senate by Senator Warren and Brown. And I guess they don't realize that without the banks helping out on the QE, Uncle Sam can't function. But they're against it because they're political. They're going against the big banks. Am I on the side of the big banks? No, I'm not either. But all I'm trying to do here is analyze things and how it could affect the markets, because rising treasury yields are no in this debt-induced system, in this everything bubble. You need to keep yields and interest rates low. So yes, could they be? Could the Federal Reserve and the Senate have given each other the nod and yes, we will extend this SLR on March 31st. It's possible. The other solution would be, of course, the debt monetization. That would basically take the banks away from the equation. Only the Fed's balance sheet would increase then, not the commercial bank's balance sheet. But that would be, as I said, a nuclear option. That would be really send a really bad message to the whole financial world, not only in the U.S., that the Federal Reserve is basically buying directly from the Treasury, basically financing the Treasury directly. And yes, the individual regional Fed banks are private, but the Federal Reserve Board in Washington, D.C. is public. It's a hybrid. Basically, this would be like the government borrowing from itself, printing money to borrow from itself. It would be highly, highly bullish for anything that isn't paper dollar. It would be highly inflationary. It would be an even bigger step towards Weimar hyperinflation if you go the direct debt monetization route, even though one could argue that that's what's happening today. But we've hit this problem, which is the SLR, because the bigger the balance sheet of the Fed gets, the bigger the commercial bank's balance sheet get. Even when the Fed's doing QE and buying, let's say, Treasury securities from the banks, you'd think, oh, that will take the treasuries off the bank's balance sheets, but it won't, because when they do that, the Fed sends the bank's reserves, or what we call money, but it's called reserves or deposits, and that inflates again their balance sheet. They'll have to go out and maybe buy short-term treasuries, which are less risky. So it's a problem, and legally, I don't know how difficult it would be to give the Federal Reserve authority to do debt monetization or to buy directly from the Treasury. But right now it seems that extending this supplementary leverage capital ratio and adequacy is a problem for Congress and the Senate especially. So this has been going on since last year. This SLR was, how can I say, removed. So the reserve requirement right now is 0. But they had to extend it last year. There's a note here from JP Morgan Asset Management. It says a Federal Reserve announcement provides temporary relief to banks on leverage and capital adequacy. So this is from June 4th last year, and it says a new rule on calculating the supplementary leverage ratio, a capital adequacy measure, allows expanded balance sheets and potentially greater expansion of quantitative easing. So this is all about quantitative easing. We know that not just the US, but the whole world needs quantitative easing right now. There's an article here on Zero Hedge, top article this morning. Here come trillions more. Biden will unveil next phase of COVID response on Thursday. So it's getting crazy. So this is what JP Morgan said to its clients. In brief, the Federal Reserve announced a new rule that temporarily excludes U.S. Treasuries and deposits with Federal Reserve banks from its calculation of supplementary leverage ratio, or SLR, a measure of banks' capital adequacy. Relaxing this calculation will allow banks to temporarily expand their balance sheets, which should help facilitate the flow of risk and liquidity through the banking system. So this is very important. This is not just about the big banks, because the big banks, it's from the big banks that the credit flows to the smaller banks, to the credit unions. Banks will likely use the relief to buy more treasuries and agency mortgage-backed securities and sell them into the Fed's quantitative easing program. The implications for liquidity investors include possibly further flattening the interest rate curve towards 0 and tightening mortgage spreads. We will need more time to determine any direct effects on the credit market. And that's the reason why as well the yield curve has been steepening instead of flattening. Steepening means that the longer term rates are going up quicker than the shorter term rates. And that's a problem as well. So the SLR would help flatten the curve if they extended. So I'll put a link to this JP Morgan asset management note to their clients. But one thing I would say is that 10, 15, 20, 30 years ago, we wouldn't even be discussing this kind of stuff because the Federal Reserve was not as important to the system. The system didn't depend as much as it does on the central bank. And it's not just in the US, it's also in Europe with the ECB, with the Bank of England in the UK. And by the way, today we have the ECB meeting, which will be quite important. Their announcement comes at 12:45 London time. They have a press conference that starts at 1:30 p.m. London. So that's 8:30 a.m. New York. Today I've got my NDECB mug. It says NDECB, fermez la BCE, that's in French. Die EZB herunterfahren, that's in German. And I've got Christine Lagarde behind bars. Yes, she was convicted to a year in prison while she was IMF managing director in France. And they didn't make her serve the sentence, but she's a convicted criminal in a special French court. Well, we saw recently that the former president, Sarkozy, He's been sentenced to prison, so it's not surprising. So you can find these kinds of mugs in my Teespring store. So yeah, will that monetization start? Even if it doesn't, that might be something that they have to look to in the future, because the banks are getting riskier and riskier. The bigger their balance sheets get, the riskier they get, the more leverage they are, the more susceptible to volatility in the interest rate markets they get. So yes, they might extend this SLR come the end of March for another 6 months, let's say. But this is going to be a problem because, as you can see, the largesse, fiscal and monetary largesse, doesn't seem to be abating. It looks like Biden wants to launch another package. I don't know how many trillion there will be in that one, but looking back at history, once you go down that road, as we saw in France in the 1790s with the assignats, they did an issue of assignats, and they said, well, this is going to be the only one just to kickstart the economy. And they found that they couldn't stop, and it kept coming, and eventually everything imploded. The currency collapsed, no confidence. So that's the road we're on, and that's why I continue to stack gold and silver whenever I can. And people ask me, when are you going to sell your gold and silver? Well, that's the same thing as asking someone, when are you going to use your savings? Well, on a rainy day or on a day where you find another asset that you think is a bargain relative to gold and silver. It's as simple as that. I don't buy or stack gold and silver to make fiat currency profits. I don't. I mean, of course, if you exchange gold and silver for another asset under a fiat currency system, yes, there's going to be the move from gold or silver onto fiat, but then straight to the other asset. So you can't, of course, circumvent the fiat, but I wouldn't just get rid of gold and silver to go back into fiat. I think that's crazy, in my opinion, seeing how the system is set up right now. So with that, let's look at where the markets are this morning. It's 8:33 a.m. London time. So we've got spot gold right now, right near the highs at 1738.70, up just over 12 bucks or 0.75%. Low has been 1722, and as I said, we're right near the highs here. Silver is up 23 cents, almost up 1%. It's at 26.43. The high's been 26.48, and the low has been 26, actually. The Dow future is up 100 points. NASDAQ is up 200. S&P is up 26. The currencies, the pound's pretty steady, unchanged, virtually 139.42. The euro is up 0.25% at 119.58. The dollar is up slightly versus the yen at 108.52. And the dollar's coming back down versus the yuan. We're now back below 650, which was a target I had months ago from a double top at 720. We broke through 650 a few weeks ago. We've come back above it, but now is going back below it. High-grade copper up 2.5% at 412. WTI crude up 1% at 65.10. So where's the 10-year yield right now this morning here in London? Well, it's just broken back below 150. So there you go. It's at 149, down about 3 basis points. So today we'll have the 30-year bond auction. I don't expect there to be a problem. They're going to get this auction through with no drama, so to speak. And the results will come out just after 1 p.m. New York. And the Exchange Stabilization Fund, which is run by the Treasury itself, they could be participating in this. So because this Exchange Stabilization Fund was created in 1934 with the profits of the gold revaluation. I think they had over $2 billion back then. So it's probably the biggest hedge fund in the world, the ESF. So they could be there intervening as well. So there you go. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Facebook, Twitter, and all these other platforms below here. I wish you all a great day. Take care. Bye.